Ever wondered how stock market analysis works? It's a question that puzzles many, yet it's one of the most critical aspects of investing. The world of stock market analysis is a vast and intriguing one, filled with numbers, trends, and predictions. Stock market analysis is the process of evaluating a trading instrument, an investment sector, or the market as a whole. It is a method used by investors to determine the intrinsic value of a stock, to make informed decisions about buying and selling. The essence of stock market analysis lies in its ability to provide a snapshot of the financial health and potential growth of a company. This process involves studying past and current data. Past data offers a historical perspective, showing us how the stock has performed under different market conditions. Current data, on the other hand, gives us a real-time view of the stock's performance and the factors affecting it. Now, you might be wondering, is there only one way to analyze a stock? Well, the answer is no. There are several types of stock analysis, each with its unique approach and focus. On one hand, we have fundamental analysis, which zeroes in on financial statements and economic reports to understand a company's true value. On the other hand, we have technical analysis, which studies price trends and market factors to predict future price movements. But that's not all. There are also other methods like sentiment analysis, quantitative analysis, and top-down or bottom-up analysis. Each method offers its unique perspective and adds another layer to our understanding of the stock market. Remember, the goal of stock market analysis is not to predict the future, but to make sense of the present. It's about understanding the market's pulse, gauging its direction, and making informed decisions to maximize returns while minimizing risks. So, ready to dive deeper into the world of stock analysis? Let the journey begin. First up, we have fundamental analysis. But what is it exactly? Well, to put it simply, fundamental analysis is akin to being a detective on a mission. Your task is to uncover the truth, the real value of a stock, hidden beneath the layers of financial data and economic indicators. It's about digging deep into a company's financial health, industry position, and market trends to understand whether a stock is under or overvalued. Now you might be wondering, how do we do this? The answer lies in financial statements and economic reports. These documents are like treasure maps, leading you to the true value of a stock. They include balance sheets, income statements, and cash flow statements, among others. By analyzing these, you can understand a company's profitability, its debt levels, and how well it manages its cash, to name just a few insights. But it doesn't stop there. Fundamental analysis also takes into account economic reports. These include data on inflation, employment, and industry conditions. Why is this important, you ask? It's because a company doesn't exist in a vacuum. It operates within a broader economic context, and so, factors like the health of the economy, interest rates, and consumer sentiment can have a significant impact on a company's performance. So, to wrap it all up, fundamental analysis is a methodical approach to determine the intrinsic value of a stock. It's like a deep dive into a company's financial health and the economic landscape, giving you a comprehensive picture of a stock's true value. And armed with this knowledge, you can make informed investment decisions, ensuring you invest in stocks that are more likely to provide a good return on your investment. Fundamental analysis, a methodical approach to deciphering a company's true value. Next up, technical analysis. Now, let's shift gears and talk about technical analysis. This is a method quite different from fundamental analysis, but just as crucial in the world of stock market analysis. Technical analysis is essentially the study of stock price patterns and market trends. It's like being a detective, looking at the history of stock prices to predict where they might go in the future. So instead of focusing on the company's financial health or economic conditions, we are more concerned with what the price charts are telling us. Imagine for a moment that you're standing at the edge of a serene lake, and you throw a pebble into the water. The ripples that spread out from where the pebble hit the water can be seen as the past and current market trends. And where those ripples head, that's the future we're trying to predict with technical analysis. Technical analysis involves a lot of charts, numbers, and patterns. It's about identifying trends and making educated guesses about where the market is headed. There are a variety of methods used in technical analysis, from simple trend lines and moving averages to more complex strategies like the Elliott wave theory or the Fibonacci retracement. But don't let these complex terms intimidate you. At its core, technical analysis is about understanding the psychology of the market. It's about identifying patterns that suggest where the price could go based on how investors have reacted in similar situations in the past. In essence, Technical analysis is a dynamic tool that can help you anticipate future price movements. It's like having a crystal ball that, while not 100% accurate, gives you a good idea of what to expect. And in the high-stakes game of investing, having that kind of insight can be a powerful advantage. Technical analysis, a dynamic tool for predicting price trends. But there's more to stock analysis. So stay tuned as we continue to delve into the fascinating world of stock market analysis. Beyond the basics, there are other methods of stock analysis too. Let's start with sentiment analysis, a method that focuses on the overall mood or sentiment of the market or a specific stock. This technique pays attention to news headlines, social media posts, and even company announcements. It's like reading the room before making a move. While it might sound a bit abstract, it can provide valuable insights into market trends that are driven by investor sentiment. Up next is quantitative analysis. This method is for the number crunchers out there. It involves complex mathematical and statistical modeling to predict future stock performance. By analyzing historical data, quantitative analysts, or quants as they are often called, try to find patterns or trends that can inform future investment decisions. It's like trying to predict the weather based on past climate data. Lastly, let's discuss the top-down and bottom-up analysis. These methods are about perspective. In top-down analysis, investors start by looking at the global economy, then work their way down to specific sectors, and finally to individual companies. It's like starting with a bird's-eye view and then zooming in. On the other hand, bottom-up analysis flips this approach on its head. Here, investors start by analyzing individual companies and then consider the larger industry and economic factors. It's like starting with a close-up and then zooming out. Each of these methods brings a unique perspective to stock analysis. Sentiment analysis helps gauge the mood, quantitative analysis provides a mathematical approach, and top-down and bottom-up analysis offer different perspectives on looking at the market. Diverse methods, each unique in its approach and utility. Stock analysis indeed is a vast field. As a new investor, you might be wondering, why is stock analysis so important? Well, let's break it down. Stock analysis is like having a GPS in the labyrinth of the stock market. It's a tool that guides you towards wise investment decisions and helps you avoid potential financial pitfalls. Imagine you're about to embark on a journey. Would you rather set out without a map, relying solely on instinct and hearsay? Or would you prefer to have a detailed map that shows you the safest and most profitable routes? Stock analysis is that map for investors, providing valuable information about a company's financial health, the market's overall condition, and potential investment risks and rewards. Now, why is this particularly crucial for new investors? Well, think of the stock market as a game of chess. Seasoned players know the moves, understand the strategies, and can anticipate their opponent's actions. New players, on the other hand, are still learning the ropes. They're more likely to make missteps and less likely to spot opportunities. In the same vein, experienced investors have the knowledge and intuition built over years of trading, while newcomers are more prone to mistakes and missed opportunities. Enter stock analysis. It levels the playing field, giving new investors access to the same information and insights that seasoned investors use. It equips you with the knowledge to evaluate a company's financial statements, understand market trends, and make informed decisions. With this, you're not just playing the game, you're playing to win. Moreover, stock analysis helps mitigate risks. Investing in stocks can be a bit of a gamble, but it's not about blind luck. By analyzing a company's performance and the market's trends, you can make calculated risks instead of reckless gambles. You can identify potential red flags before investing your hard-earned money, reducing the chances of financial loss. In a nutshell, understanding stock analysis empowers you as a new investor. It boosts your confidence, enhances your decision-making skills, and ultimately, increases your chances of achieving financial success in the stock market. Knowledge of stock analysis, a powerful tool for every new investor. So that was a brief tour of the world of stock market analysis. We have embarked on a journey together, exploring the intricacies of stock market analysis. We've seen how it becomes an essential tool for new investors, helping you make informed buying and selling decisions. We started off by getting familiar with the term stock market analysis, and how it helps evaluate a trading instrument, investment sector, or the market as a whole. We delved into the world of fundamental analysis, focusing on financial statements and economic reports to understand the intrinsic value of a stock. Then, we navigated through the landscape of technical analysis, which analyzes price trends and market factors. We saw how it helps in predicting future price movements based on past patterns. We also explored other methods of stock analysis, including sentiment analysis, quantitative analysis, and top-down/bottom-up analysis. Each of these methods offers a unique perspective, enriching your overall understanding of the market. Remember, the essence of stock analysis lies in its ability to aid you in making sound investment decisions. It's not about predicting the market, but understanding it. It's about gaining insights into the factors that influence the value of stocks and using that knowledge to your advantage. As new investors, understanding the nuances of stock analysis is crucial. It equips you with the necessary tools to navigate the financial market confidently. So, I encourage you to delve deeper into each type of stock analysis, continue your learning journey, and hone your investing skills. Remember, the stock market isn't a gamble if you know how to analyze it. Until next time, keep learning, keep investing. If you found the video helpful, do subscribe to our channel and hit the like button. Thank you for watching.